In this week's video, we'll show why it's a good time to check your bear market contingency plans. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In last week's video, we talked about how the hard data was telling us we were near a possible inflection point and that a sharp move may be coming in stocks. After last week's video was published, we did indeed get a big move. In fact, we had the worst 4-day percentage loss to start a calendar year, dating all the way back to 1897, which means we had the worst 4-day percentage loss to start a year in 118 years. The first trading day of the year, this single trading session, the Dow had its worst start since 2008, and the S&P 500 and the NASDAQ got off to their worst start since 2001. We normally wouldn't pay attention to a data point historically that references one day on the calendar, but there are a lot of similarities between 2001 and 2008, as CNBC just noted in the previous slide that 2016 was the worst start since 2001. As the 2001-2002 case shows us, a bear market is more than a one-day or one-week event. From the end of the first week, January 5th, till the end of the bear market, the S&P lost an additional 41%. The takeaways here: we're not really at this point yet. The 50-day is on the 200-day. This is something that we could morph into. We're a little early here, but the setups are there. Some other takeaways: this is the primary trend. It is down. The model helps us discern between volatility to ignore, 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 and volatility to respect when you get a probabilistic turn. Why is this volatility to ignore for the most part? These are counter trend rallies, normal and strong counter trend rallies within the context of the primary trend, which is down. You'll also notice that navigating through a bear market, just like a bull market, is not easy. And that's why the discipline and the rules and the facts are what we'll rely on, as we always do. 2016 kicked off with the worst percentage loss on the first day of the year since 2008 for the Dow. Looking at the S&P 500, this is the end of the first week. We had a big drop in the first week of 2008. Was the event over? The answer is no. After the ominous start to the year in 2008, from the end of the first week to the end of the bear market, the S&P 500 lost an additional 52.8%. In this case, the 200-day was useful. The slope stayed down and price, for the most part, stayed below it. Also note the sharp counter trend rallies that take place in bear markets. So in the present day, we have an ugly profile in early calendar year 2016. Even if that probabilistic profile leads to a bear market, we can have a sharp counter trend rally at any time. The market's not going to make it easy on anyone. We're starting to see similar things to what transpired in 2001 and 2008. Is this type of information useful? This is an article that we wrote in early February of 2008. We quoted Abraham Lincoln. I think the necessity of being ready increases. In the first paragraph of the article, the probability of investors incurring additional losses over an extended period of time has increased. Both the technical and fundamental outlook now favors bearish outcomes over bullish outcomes. The technicals were very helpful in that case. From the date, February 13th, to the end of the bear market. So after the article was written and after the technicals were waving yellow and red flags. The S&P 500 dropped an additional 51%. Were they helpful in 2009? Another article that we wrote when things started to turn, the title was, "If it looks like a bull, walks like a bull, and acts like a bull." The purpose of the market model is to leverage things that we've seen work over long periods of time. The model adds in the necessary discipline to leverage useful information. As we headed into the new year with the inflection point data, we had similarities to bullish cases like 1994 and bullish cases like 2011. If the probabilities are starting to lean towards the bearish end of the spectrum, we would expect the hard data and the facts to start to negate and move away from the bullish analogies. Back on December 18th, we said that the 2011 analogy was still alive, but that the window was closing and that the bulls needed to take action soon. See S&P 500 daily in 2011. These are basically arbitrarily chosen moving averages. Starts with the 25-day in blue and ends at the 200-day here in purple. Point of the exercise: if the present day looked like this, then we could say there's a chance that we could still rally. Why? From this look here in 2011, the market rallied. How is this analogy holding up? As of last week's close, this chart here is the 2015 version of the exact same moving averages. This is December 19th, 2011. You can see they look fairly similar. The moving averages are in decent shape here, and out of this formation, we had a strong rally. If the bearish analogies are starting to carry more weight, we would expect the bullish analogies to start to break down. This is the exact same moving averages as of Friday, January 8th, 2016. You can see now this really doesn't look anything like the bullish setup at the end of 2011. In fact, the moving averages are starting to roll over and price is now below all of them. Before we move to the present day charts, it's important to emphasize, remember where we're coming from. December 27th, title of the video, are stocks near a major inflection point? So what we're looking for as we head into trading this week are clues that are telling us the inflection point might break up or the inflection point might break down. We'll be using Fibonacci retracements on numerous charts and with numerous risk-on, risk-off ratios. So let's review how the fibs help us. S&P 500 daily as of year-end 2015, or a week ago. The move, the rally from point A, the low, to point B. The fibs help us with a normal retracement after a bullish move typically stays within a 38.2% retracement of this move A to B, a 50% retracement of the move A to B, or a 61.8% retracement of the move A to B. So you can see from an inflection point perspective, last week we really don't have any new information on December 31st. Why? We really haven't made a new high, nothing really convincing from a bullish perspective, and the S&P 500 is above all three of the fibs, telling us that for the most part, this looks like a normal retracement after a move A to B. Let's fast forward a week. As you can see, in just 5 trading sessions, we've blown through all 3 Fibonacci retracement levels. This just tells us that the probability of good things happening is lower today, and the probability of bad things happening is higher. And it also tells us this no longer really fits into the typical retracement realm. Is it possible for retracement to exceed 61.8? Absolutely, positively, yes. Typically, it doesn't, but it can happen. Markets can do anything at any time. These were areas of possible support for the S&P 500 daily as of December 31st, roughly a week ago. We have the inflection point look. What can we learn from this chart a week later? We can gain a better understanding of why we always use the term possible support. And support gives us good information either way. If it holds, it gives us bullish information. And if it breaks, it starts to speak to bearish probabilities increasing. This is the broad NYSE Composite Stock Index as of December 31st. Here's the exact same chart on January 8th, 2016. Notice we have a break of a trend line, step one for a trend change. Then we've made a lower high relative to this high. And this week, what's new on this chart is we made a new lower low. This is starting to look like a downtrend, at least from a probability perspective. Notice the large counter trend rally here in 2008. This pattern won't change anything that we do, but you can see a left shoulder, a head, and a right shoulder, and the neckline in this case has a negative slope. When we have a negative slope on the neckline, that makes the pattern from a probability perspective even more bearish. You can see here in 2007 and 2008, we've got a similar situation. Our neckline here slants down, left shoulder, head, right shoulder. After that, bad things happened. Does that mean bad things are going to happen in 2016? No, but it does say unequivocally that the probability of bad things happening over the next few weeks and next few months is higher today than it was even a week ago. The market model tracks the weight of the evidence, so everything that we just said also applies to global stocks. Similar look, a lower low here, similar look back in 2007, 2008. As we entered this week, we were looking for evidence that would help us with the inflection point question. Here's SH, or the inverse S&P 500 ETF. You can see it cleared numerous forms of resistance. This is risk on versus risk off daily SPY relative to SH. We have a rally December 31st. This looks like just a typical retracement above all three fibs. If we fast forward just 5 trading sessions, it tells us that from an inflection point perspective, our mixed probabilities are now leaning towards bearish outcomes longer term. A lot of the things that we're showing here aren't particularly earth-shattering, but they do speak to the weight of the evidence and which way it's leaning. TLT, resistance, resistance, resistance. We broke above and closed above the blue line on Friday, January 8th. This is a daily chart of the Japanese yen ETF with the ticker symbol FXY. This is 2009. This is 2016. Here you can see we were in a downtrend. We have something that looks like an inverse head and shoulders pattern, which would be a probabilistic bottoming pattern. And we appear to have a breakout above 2 lines here. Why is this potentially relevant to the bigger picture? There are numerous reasons, including the market may believe that the Fed's not going to raise interest rates as fast as they're leading on, and thus that would hurt the US dollar and it might help the yen. Also, in 2008, there was only a handful of non-inverse based ETF winners during the financial crisis. One of them was FXY. When the S&P 500 plunged and lost over 35% in 2008, FXY gained 22.98%. This is the weekly chart of the yen or FXY. RSI has now hit levels that were not seen in calendar year 2015 nor 2014. From a weight of the evidence perspective, we also have some trend lines being cleared by defensive-oriented IEF. This is a daily chart. S&P 500 daily as of the close on January 8th, what once acted as resistance may now act as support. This line has been relevant. We blew right through it this week. Remember, heading into the week, we're looking for things that might tip us off in terms of the inflection point, and more importantly, the risk tolerance of investors to monitor that all-important net aggregate opinion, SPY, relative to defensive-oriented TLT treasuries. It's a long-term chart. This is 2012. Support for the ratio, support for the ratio, support for the ratio. If we fast forward a week, we can see the ratio closed well below the blue line. We also have 2 of the 3 steps for a trend change. If we clearly make a lower low down here, that would be step 3. Same ratio daily as of December 31st. These are fibs. And over the last 5 trading sessions, all 3 of the major fibs were taken out. NASDAQ daily as of December 31st, we have numerous forms of possible support and a gap well below. A week later, all of them have been taken out on the downside. One of the weekly charts, followed by the CCM market model. It does a good job helping us with the inflection point look. It's the close as of December 31st. You can see our moving averages are flat. They're very, very close to each other, and price is there. We also have potential support and a clear uptrend off of this low still in place, and we have our bullish breakout here still in place. A week later, our indecisive look has morphed into a look that favors bearish outcomes from a probability perspective. These are our longer duration moving averages used for illustrative purposes only. December 31st, you can see price is above all of the moving averages, and our moving averages are, for the most part, flat. Another very indecisive, this could go either way look. If we were looking for clues going forward from the indecisive look, the clues in this case are favoring bearish outcomes, looking out several weeks or several months or maybe even longer than a year. Tight moving averages. Price was above all of them on December 31st. Now it's clearly below all of them, and the slopes of all of them have rolled over. The triple Qs weekly are tracked by the CCM market model December 31st. This is clearly an indecisive look. Blue is right on top of red. The slopes are slightly up, and price is right there with them as well. Fast forward a week later, and we have a much, much different look. Notice the look in here is similar to the present day look. This chart can improve at any time, but we need to see that improvement, not forecast it or hope for it or predict. Another ratio tracked by the CCM market model, risk on, risk off, S&P 500 relative to a diversified basket of bonds, or AGG in the ETF world. Incredibly indecisive, very similar to the indecisive look on the triple Qs as of December 31st. Also with a similar outcome and message. These 3 lines have been relevant to price in the past. This is as of December 31st. Above all 3. A week later, below all 3. These are the NASDAQ closing Fibonacci retracements as of December 31st. Price was above all 3 of the major fibs. Friday, January 8th, below all 3 of the major fibs. S&P 500 daily as of the close, year-end 2015, December 31st. We were basically in the same trading range with numerous areas of possible support, including this gap below. If we fast forward just 5 trading sessions, we find that price is below them all on every chart. What once was possible support may now act as possible resistance on any counter-trend rally. If we understand what extreme fear looks like and extreme confidence looks like, it can help us with everything in the middle. 2008 here, you can see we have the indecisive look and the tight moving averages. Eventually we break below. If we look at the exact same weekly moving averages as of a close on Friday, January 8th, you can see we have the slopes are all down, price is below, and we have the tight cluster. In terms of similarities, there's no question that the present day here looks more like this period here in 2008 than this period here in 2009. As we close this week, it can't be emphasized enough. We are not predicting probabilistically that the stock market will fall on Monday or next week or even the next several months in some cases. The probabilities right now are leaning towards possibly, we're not quite there yet, a shift from a bull market to a bear market. It's something that we need to respect and keep in mind. And as always, we know that charts can begin to improve at any time. We have to keep a flexible, unbiased, and open mind. If we do that, the hard data, the moving averages, the risk-on, risk-off ratios, the model, and maybe most importantly, the discipline and rules will help us stay aligned with the primary trend, whatever it may be, down or up. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.